morning, friends. We will begin soon in the next couple of minutes. Thank you so much for your patience. Dear friends, welcome to today's session. We are excited to get such a fantastic response. Today, we not only have the entire research team of our organization, but we also have a special guest. Let me begin by introducing our guest for the day, Mr. Rahul Jain. Mr. Rahul Jain is the Vice President Research at Dolat Capital Market Private Limited. He has more than 15 years of experience in the capital market, of which a large part is tracking the technology sector. He also understands sectors such as new age companies, real estate, education, and autos. He has hosted several conferences and roadshows. He has been widely recognized across domestic and foreign institutional clients for his research, modeling, and business understanding skills. Friends, now let me introduce you to our Chief Investment Officer, Mr. Jaspreet Singh Arora. Mr. Jaspreet has close to 2 decades of experience in the investing space. Let me hand over to Mr. Jaspreet, who can tell us about his association with Rahul.
Thanks so much, Shyam. I welcome everyone today for this discussion, and I'm extremely delighted to have a good friend and ex-colleague joining me today, but more as an IT expert. A couple of points, friends, before I start. Rahul would be talking of his call of being underweight stroke negative on the IT sector has been bang on in the last 1 year, and while he's been very selective on his stock picks, and he'll be sharing with us today why he believes the next year could not be or may not end up to be very different from what the last 1 year has been like. The view on IT or the platform companies would be also be shared. He has an extensive coverage there as well. So a deep dive into the IT sector, the outlook, what's some of the strengths, weaknesses of the stocks, that some of them we have already gathered because we had a poll and we had a very interesting participation, and live questions we would also be taking. So this entire theme of the next 55 minutes max, we would be spending on the IT sector, and then we'll have to Rahul has so many other commitments. The last few days has been very hectic. And then we'll continue our discussion on the other sectors. If you could just allow me a second, I will just show you 2 slides that will set the context. Is that visible? If yeah, okay, great. Let me read out the disclaimer. That's very important, and Dolat's disclaimer would also be there at the end. So stocks mentioned in today's session should not be considered as a buy, sell, or a hold by recommendation from RNR. Please do your own due diligence, consult your own advisor, and then take a call. It's being only discussed more from an education illustration purpose, and the Equintis or its group companies, directors, employees, etc., may or may not have a financial interest in this. So we might have a vested interest there. Second, and very important to set the context, is I was just curious to look at how IT's behaved in the last 5 years, and what I noticed was that and it'll be very interesting, right? So FY19 IT gave like a good 10% alpha. F20 again alpha, right? Because the IT sector fell lower than Nifty. This is a COVID year. The year next, again, this is like some crazy 30% alpha that IT sector did. This continued, right? This continued in F22 as well. अब इतना सारा देख के मतलब आदमी तो एकदम आसमान पे चढ़ गया होगा कि मतलब IT तो लेना ही लेना है. And guess what? What did the last year turn out to be, which is F23 minus 20% alpha. So this is something that astute people जो थोड़ा जो ज़्यादा गहराई से समझते हैं ये सेक्टर, जिनका एक्सपीरियंस है, वो इसको पकड़ पाए होंगे और इस पे इसका एडवांटेज ले पाए होंगे. And glad to have one of such persons with me today, which is Rahul Jain. With this, let me just stop share. Yeah, I've stop share, and I now hand it over to Rahul for him to start the session and do the start with the slideshow as well. Over to you, Rahul.
Sure. I hope I'm audible and you can see my screen as well.
Yeah, Rahul, you can go ahead.
Yeah, can you hear me and see my screen as well?
Yes.
Yeah, thank you. Thanks for the warm introduction. And you know, as you said, this is a sector which has been in quite rage for last couple of years. First, post-COVID, from a very, very positive traction point of view, and in this year, in terms of the kind of pain it has given, but nevertheless, the hope and expectation from the space has not gone away because of the recency that we have seen in this thing. So I'll cover up my thoughts through a lot of slides, but I'll rush through some of it because, you know, if you are into a sector, you keep like to talking about it, but we have to also mind in terms of the time. And also, of course, if you have something very specific, we can definitely take if there are a Q&A slot as well at later point. So as Jaspreet also introduced that what kind of a view we had at the beginning of the year, very basically, if you see, the logic was very simple, which required no expertise, but a slight common sense. We picked up our thought from, you know, the Russian-Ukraine war. And soon after that, we heard 400 to 500 global corporation, which said that they want to leave Russia lock, stock, barrel, or they want to stop doing new business with Russia and those kind of thing. And there was more than a couple of thousand sanctions which were announced by, you know, various US and European corporation on that market. And some of these companies mentioned that their revenue from these markets is close to 1 to 5%. And we saw that when these fortune companies are going to lose revenue in that range, they are definitely going to see a major impact on their revenue. And there was a lot of inflation worry, especially on 6-7 commodities, which Russia and Ukraine are relevant player from a global supply chain point of view. So we saw that there would be a revenue growth impact for fortune companies. There will be a margin impact, which will eventually turn out into lowering IT spend over time. And that's what led to our view. And we downgraded the sector in March of last year. It has played out so far in that direction. We see those worries are not completely out. And some of those things we have observed in Q3 and more acutely in Q4. So I'll run through with that opening thought. You know, I'll run through slide and try to prove my point with more data points. So if you see, just a sec. Okay, so if you look at the, you know, our thesis, which I said was led by what is the developed market growth, you know, that's where we derive from a top-down approach. And if you look at the data which Gartner publishes, which is one of the most recognized third-party research agency following the IT spend globally, this spend growth globally has been clocking a 3.3% CAGR for last 10 years. So that is because that is what you can say how the TAM is growing on an annualized basis. And this becomes kind of a benchmark. So any growth which you're doing upwards of 3% on a CAGR basis is basically a market share win. And this, of course, as you can see in the down table, that this has been varying, but it's broadly in a very narrow range. It does not move very high number like what we see on Indian IT side, because this is a global spend. And it has reached 1.2 trillion. And now in the last 3 years, if you see, it has grown at 6% CAGR. If you see the CY 19 to 22 thing, which was basically led by, you know, COVID-led digital transformation and those kind of cloud adoption, those kind of things that we keep hearing from IT companies. But long-term average, irrespective, even including those 3 years, is close to 3%. So that is what one should keep in mind in understanding how the industry is going. Then if we see what is the flow through to Indian IT, and from that perspective, if you see that last 10 years CAGR is close to 8.5%. From an IT export point of view, it is 10% CAGR. Now, if you see what the NASSCOM is predicting for this year is similar to lower growth than FY23. So these are again, some of the indicators which is suggesting that, what is the kind of growth we are expecting for the sector. And if you see this last 10 years CAGR of 8.5% is more than 2x of what the global IT spend is. So Indian IT players continue to win market share. And if we see from a pure size perspective, we have reached 20% of the global market share in terms of our Indian IT players. So we are an important player and we will keep winning market share because we are the lowest cost producer in the world. But our ability to win market share beyond a certain pace is something which we have to keep a tab on. And if you look at this annual data on IT export, it's usually at $10 to $12 billion of incremental revenue. And FY22 was one major exception where incremental revenue were upwards of $25 billion, which was a massive growth year. Outside of that, just before COVID, if you see the years of 17, 18, 19, 20, the growth were in the range of 7, 8, 9%. So what we are trying to bring here as a point is that our mind, when we were looking at the sector at the beginning of the year and even now, is that we think our recent growth, if a large cap company was growing at 12, 13, 14%, or the mid cap company was growing 20, 25%, we just believe कि अरे 15% growth क्या है वो तो आराम से हो जाएगा, 10% growth क्या है तो आराम से हो जाएगा. But if you look at the same companies, these very companies, if you look at their growth in different 5-year period in the last 10 years, these are the CAGRs they have delivered. And what are expected out of these companies are from a consensus forecast perspective, you can see in the rightmost table where you see the expected growth rates are even higher despite delivering very strong growth in last 3 years. So I think our mind is tuned to a very recency bias. If we look at a long-term data, we will just see that all this mid-tier company were growing even slower than large cap company in the recent past. And that's why to expect that they will definitely do a much higher growth rate is a significant risk in eventual outcome they may deliver. So this is just a data to showcase what are the long cycle CAGRs expected. And the implied growth in the next 2 years, of course, it has toned down in this result season because a lot of guidance have come. But prior to that, these were much higher than any 5-year period the companies have seen in the last 10 years. So this is just a data to showcase the recency bias in our mind. And of course, if we see why it may not happen, somebody can debate if it does not happen in last 10 years, does not mean it cannot happen now. But with, banking crisis in US or, if you look at some of other factors, we just see that we don't see that conducive environment for that to happen now because some important space should do well to support that argument. That argument of digital transformation, cloud adoption was very relevant in the COVID scenario. But as the economies have opened up, markets have opened up, enterprises are investing in technology, but they are also investing in their physical infrastructure. So that's where the difference of opinion comes in. Now, what are the key indicators for us to look into going forward? I think guidance given by the tier 1 and some of the mid-tier name are easy data to look at. We all might have followed Infosys guidance of 4 to 7%, HCL 6 to 8%. which clearly says that we are going to a normalized growth rate for the sector of that 8% number that we saw on a long 10-year CAGR basis. Some of the mid-tier companies continues to do well, and they may continue to outperform, but we should see them with an element of risk. Some of the metrics have started weakening for some of the players in Q3. Q4, we have not seen new names getting into weakness, but probably it's a very strong execution, which can see a troubled situation at some point of time. But that we have to wait and watch. But company like Persistent, Coforge have done well, even from their guidance and outlook perspective, even from Q4. And what we heard commonly everywhere is that, yes, the growth can come back. It is back-ended. What is impacting right now is project ramp down, cancellation, delayed decision-making. This has become the most discussed reason why the numbers are not coming in. And as you can see, initially everything which is not started looks like delayed decision-making, but if macros get weak further, it turns into cancellation. So we have to just wait and keep waiting. And then from that point of view, what is very important is to see that what has been the track record of commentary of those companies historically. Do they overachieve their guidance? Do they underachieve their guidance? And accordingly, we have to calibrate our thought. Some of the data that support this is this YOY CC growth trajectory, which has been coming off, if you can see in last 3-4 quarters. FY21, we saw every quarter that trajectory been improving after the COVID-led hyper demand that came in the second half of 21. 22, it extended. And 23, we can see across the board that momentum has been coming off. If we would tabulate the Q4 data, which has mostly come up for most of the names, the same numbers have now gone to a much lower trajectory of close to 10% for large cap and 14 to 19% for the mid-tier names. If we look at the TCV data, which is something which can support the growth continuity, so the data is not grown much if you look at compared to FY22 data for most of the players. And as I said, a most important parameter here is the number that they talk about in terms of delayed ramp up. So you may have deal TCV in your bag, which act as a lead indicator, but what if the client is not starting or starting with a lag? That would mean that a project which you have may not fructify in the same timeline. The same 12-month deal can materialize over 18 months. So that way your growth can get subdued. So that is another factor which we have to keep in mind. So we are not very pessimistic about the prospect, but yes, this decision making getting delayed could change the growth that we may be thinking of the business, and that adds to incremental risk versus the kind of valuation the company might be trading at. That is what one should be mindful of. Again, more data in terms of what is the headcount growth, what is the net addition that we are observing. In many cases, it's started declining in Q3. In Q4 also, it has declined in many cases. So all these indicators are clearly suggesting that now they know that demand from being very strong, and there was a time just 9 months back when everybody was talking about extraordinary wage hike, extraordinary attritions, and now that trend has clearly changed in a matter of just 2 to 3 quarters. So that is how the macro can change very fast, and one should be looking at more lead indicators to see how it has played out, and that's how the markets are lead indicator, right? We saw the correction starting in April, and the data from a headcount perspective, we could see only in Q3. Margin perspective also, a lot of these businesses are under pressure. Most of them are saying that we can maintain the margin, we can improve the margin. My simple thumb rule logic is, if the businesses were not able to improve margin with 20% growth, how they are going to retain or improve the margin with 7% growth or 10% growth, I think that is going to be a bit tricky. One only significant lever these companies have is that they may not increase their headcount, which they have already started doing it, and more focus on improving utilization. That's the only meaningful lever, because outside of growth, no other lever can play out so much well. And the only cause that can really help is the headcount reduction or improve utilization, because the growth is going to be very low in this year versus what every company has done on a previous fiscal basis. I think from our thesis perspective, large cap, we have really seen those moderation have already happened in terms of what is the growth expectation in that business, and what are the multiple these companies should trade with that lower growth rate. And we don't see pain in the tier one name. I think those are very well priced in, and we know these are super businesses in long-term to medium-term basis. But I think risk still remain in some mid-cap valuation, which we think should moderate. And this is a study we did just which may help you you also in terms of understanding how these companies have done well as a portfolio over the long term, to understand, because as I said, our mind could be thinking that these businesses are super businesses and they are growing at 25%, 30%, and that can happen forever. So what we have done here is that we have combined data of top 5 company and then combined data of the next 5 companies, and have just showcased that what kind of growth they have done historically. If you see in the first cycle, which if you see from FY13 to 16, actually these companies used to grow slower than the large cap. Then, of course, some of these companies saw a lot of changes on their CEO. A lot of companies became changed guard in terms of ownership, and a lot of private equity companies came into these businesses, and they have changed the efficiency model and made those companies very aggressive with tying up the management remuneration to stock performance and those kind of things. And we have seen eventually in last 3-4 years that this mid-cap companies as a portfolio have done far better than the large cap. And you can see that data starting FY18 when that has happened. So now we think this superlative performance has led these companies trading at a discount to tier 1, to these companies trading at a 30-40% premium to tier 1 companies. But what we have observed in a low growth scenario, this growth differential generally narrow down, and that is what may happen. And so we have to be careful that if the growth rate differential between large cap and mid cap will narrow, then the P that they are commanding, superior P, may not be there anymore, and it may shrink. Like what we have seen in case of, let's say, LTI. Now it's going to grow at, let's say, 10% or 11% this year, while even in HCL Tech is going to grow at 6 to 8%. So for that 20% premium growth, the stock is trading, let's say, 30-40% premium to that company, and for a similar margin profile. So why this gap should continue if that growth is not very, very superlative? So those kind of things may play out during the year. And as I just said, we have divided this thing into phases, but this is a long conversation. So I've just summed it up earlier for you, that how these 4 phases have kind of played out. Going forward, as I said, we expect this growth differential between mid-cap and tier 1 names would narrow, as has happened in the past cycle. And that would also mean that that premium between tier 2 companies will also narrow down. And that is the only moderation we expect to happen. Large cap, as we have already seen, has corrected significantly during the year. And now they are trading at their long-term mean multiple, and in some cases even lower than that. So we don't see risk there, but we definitely see risk in the mid-cap valuation. And this chart basically depicts that how, we have pegged it against TCS, where you can see the mean for last 10 years is minus 14%. So basically the mid-tier as a portfolio used to trade at a 14% discount. But now at this point, even today, it's trading at like 8% premium. So as growth narrows, basically this 8% premium will go towards minus 14%. We don't know where it will stop, but I mean, directionally, this gap should narrow. And what could be the risk to our overall thesis? I mean, some of these things are very standard, but I think one thing we should be very mindful of is the BFSI growth. We have seen in the past that BFSI as a space is the biggest in terms of contribution of total IT spend for Indian companies and also globally. And this company, whenever there is a big crisis or challenges, there are more regulation that keep coming in those markets, which actually leads to a lot of demand, pent-up demand. So like we saw that how Dodd-Frank easing out has resulted into the SVB crisis. Now there is a lot of talk that another version of that Dodd-Frank Act would come. And, these kind of event can possibly lead to a significant opportunity from compliance, analytics, risk management perspective, and Indian IT services could be beneficial of it. But will that happen in the second half of this year? Whether that happens next year, we don't know. But that is a risk to our thesis when with that probably we may also turn positive if that happens. And of course, the most famous one of QT or QE is the biggest swing factor, as we all know. So that can definitely change the P for the sector, if not the earnings. Then we have the company specific slide. Jaspreet, what do you suggest? Should we go for some of these names, or this will be more on demand basis?
No, you can. What I'll request is if you can spend a minute each. Friends, we have just collated whatever basis, whatever the poll that we got results from the poll on the Zoom link that we have shared. So we have got a tremendous response. So we have selected the top 6 names, and I think 1 or 2 of them are from the non-traditional tech space. So we'll spend a minute each on the strengths and maybe 2 or 3 strengths, 1 or 2 weaknesses. And broadly, what's the let's say what's the conclusion? Can it be an outperformer, or does it have a high risk, high return kind of a framework? And then after those 6 minutes, we can move to individual questions. And maybe in case there is a demand, we can come back to TCS or any such name later. So maybe a minute to minute and a half on each of these 6 names. Thank you, Doug.
Sure. Thank you so much. So, as I've been given some name, some of them are also my preferred names. So I'll run through each of them with my perspective. First, to begin with, TCS, of course, they don't give you a very specific guidance, so we don't know how they are going to play out this year. But one very important data point which they shared in the previous annual report is that they aim to take the business to $50 billion on a certain time frame. And if you do that implied maths, they expect their business to grow at 7 to 8% CAGR, doubling the revenue from $25 billion to $50 billion. I think what we have observed in the last 10 years that this company is most consistent, least volatile in its performance, and it's the most important part of anybody's IT portfolio, I would say. We don't see any big delta coming in, but I think anybody who likes to keep the risk low and expect a consistent return of 10 to 15%, I think this kind of name qualifies, because typically if you see this company can grow at 7-8%, and then they can always India get 2 to 3% of benefit from INR depreciation, and then add to that the payout, because these companies are committed to pay more than 85% of their payout. So that makes a construct for 12-13% kind of a return on a consistent basis. for a tier one business like this, I think anybody with a medium to long term perspective should have this kind of a name, and there they may see some reaction here or there because of the market situation like we see for BFSI right now. But they've been most consistent, and they have reached a status where a lot of their deals are proactive by nature. So in a weak demand scenario, I think players like TCS tend to get benefit from a vendor consolidation process, and their strong payout make it an attractive zone for somebody who is looking for consistent and stable returns. Risk, of course, are the standard risk that we see from slowdown perspective, macro perspective. Larger businesses like TCS with global market share to the of 2.5%. These companies' performance cannot be very different than what the global spends are. So they cannot do much better just because of execution. So they have to deal with the global uncertainty into their business as well. So that is on TCS. Valuation wise, yes, it's slightly higher, but it commands that kind of a valuation because of low volatility and sector leading margins and consistency in growth historically. On a 10-year basis, it is the fastest growing business, surprisingly. And the only company that is able to maintain the margin from a 10-year perspective, while every other business have seen margin compression. Moving to HCL Tech, which is incidentally also one of the preferred name when we do our recommendations. Why we like specifically this name is the growth consistency again. For this year, they have given 6 to 8% guidance. As a business, they have a slight variation and deviation from the typical IT services company because they have a very large ER&D practice, which we all know has a better 5-10 year opportunity versus a plain vanilla IT services. They've also ventured into product business a couple of years back, and that business is very high margin, but a low growth business for them now. But that has definitely increased their presence and reach to much larger market rather than traditional US, UK kind of a market which Indian IT companies have been targeting historically. Through this product software reach, because this product were originally owned by IBM, and they get a default MSA into some of this large ecosystem of enterprise in market which are less tapped like Japan, China, and some more. So that is another way to look at in terms of what could drive the next leg of growth for the sector beyond these popular developed markets. So that is a differentiating angle. And margin also, they have kept it similar to what they've delivered. So that way it gives you comfort. The risk again are standard in terms of what you see on a global macro front. But their stated guidance gives us some comfort that the volatility possibly could be lower. Moving to the next name, which is LTTS. As I just said, ER&D is a bigger opportunity in terms of penetration potential versus IT services. Is a relatively just a decade-old opportunity where third-party players have started taking a bigger piece of outsourcing from global research spending corporation. And LTTS is one of the largest pure play ER&D services provider from India. They have, importantly, they have a very diversified piece of business. Like we also know some of the other businesses in the ER&D space like KPIT, which is very 100% auto-centric, which has a different niche advantage, but scalability, of course, is a function of just one vertical, which is not a constraint in LTTS. That way it's diversified. And we all know this is an offshoot of L&T, Larsen and Toubro, which gives them tremendous advantage of knowledge curve of various industries, because L&T, as we know, have been the infrastructure major, has business interests in energy and EPC and oil and gas and every other market. So they have those expertise to be leveraged on the digital side in the LTTS business. So that's a key differentiation. And for this year specifically, they have already guided 20% plus CC growth objective, although a big part of it is inorganic, almost 10% through the recent SW acquisition that they've done. But organic growth at 10% is also good. And more importantly is the valuation that have corrected, while some of the other ER&D options that we see are trading at a significant premium, names like Tata Elxsi and KPIT, and maybe even the Tata Tech IPO. So I think anybody looking from a medium to long-term perspective can definitely consider LTTS as one of their portfolio choices. And from a risk perspective, one has to be a little more careful in this business. Could be more volatile because these are more project-oriented versus annuity businesses that we see in case of IT services. And that's why if macro turns out very weak, then probably this businesses would see a much more severe hit versus IT services, just like what we saw in the COVID year. Of course, they've come very sharply from there, but initial period was very tough for these businesses. Moving to the next name, which is Persistent. I think this company has done extraordinarily well in last couple of years with the change in the leadership. Company has expanded its capability, focusing on the new age technology, hyperscalers, Salesforce, and those kind of software, and piggybacked on major adoption on those products, and have seen more than 30% CAGR in the last 2.5 years. And one thing we have to be careful out here, that they have a very strong execution, but as you could see, a data point, which is a point number 2, where we are saying that TTM ACV stands at 1.17 billion, which is like 1.13 times of their revenue. So this number used to be 1.3, has moved to 1.13, which clearly suggests that the growth traction is sort of coming down over time. And we think this could result into slowing of their growth, which is as 20% YOY organic growth in Q4 to more like 12 to 15% zone in over the next 3-4 quarters. So this is one example which I highlighted earlier. Could be on a slightly high risk side because their execution is strong. So that's why their multiples are very healthy. But as the growth rate would slow down, then probably we could see a risk of P multiple coming off for such names. So that way I would categorize this on a relatively high risk situation based on our original thesis that we articulated earlier. So that is one risk other than the macro risk that we generally see for the sector. Moving to some of the new age businesses, or what we call as internet business, our own IRCTC is the name that we like here. We all know that it's a part of the business is internet, part of the business is more like a license company, so which are very high margin opportunities. And we have seen that the business have significantly scaled up profitability because of this. Last couple of years have seen a lot of up and down in this stock, because first because of the travel getting impacted in the COVID scenario, and we saw the stock going down, and then they scaled up very fast because they got a lot of new opportunities in terms of 2S reservation, which is not with them in the last 3 quarters, and also the catering business pricing, which got revised by 50%, which led to a significant growth in revenues as well as profitability. We think there are a lot of untapped pricing opportunity in the business, especially in the packaged drinking water space, where their price have not changed for more than 12 years now. Last was changed in 2012. So this has to happen just like in catering it happened. And also even the service charge on the ticketing, which is as 15 rupee and 30 rupees for non-AC and AC, this may also get revised upwards at some point of time, which can create a big leap of profit pool for the business, because that is a 85% margin business on the ticketing side. So there are plenty of levers. One has to be patient out here. It's a kind of a monopolistic business, and all of it's, we know that entire India uses this service. So there's a lot of scale, a lot of potential even on the pricing side. There's no near-term trigger that we see right now, but we cannot time this kind of a thing. So for the high growth potential business with high margin and monopolistic nature, one can definitely have this as a low risk kind of an opportunity, and with a good optionality of a high return at some point of time, if somebody looks from a medium term perspective. Then probably we'll come to the last name, which is Affle. As we know, this is an ad tech business. This is a space which is doing very well in the last couple of years. It's a new age business, because as we all observe as a consumer, that ad tech or the advertisement spend for born digital companies and even for some other traditional brands are completely moving on the digital channel. And that is the best way to target a consumer, because it can be optimized to the level of the consumer and a far more data can be captured. So Affle is the only listed player in India which is targeting this opportunity. Even beyond India, they are present in a lot of other developing market like Indonesia, which also has a very similar dynamic like ours. So they have a very, very long headway in terms of opportunity of ad tech, ad spend shifting to digital. And they could be one of the biggest beneficiary in India and some other market. The company have done 20% revenue CAGR ever since they have listed. And they also have a lot of inorganic capability, which they have done through 4 or 5 acquisitions that they have done. And in most cases, they've been able to buy them at a very low multiple on price to sales basis, and have turned around those loss-making business into a profitable company level kind of a margin business. So that way they've done a lot of value creation ever since this company has come into play. The stock has seen some correction because US market have seen some impact on the ad spend, and that is possibly giving an opportunity out here for medium to long-term player to eventually participate in the company, because the valuation wise, the stock has been trading in upwards of 30 to 40 times in last 12 months. And now it has kind of come to sub 30 level. So anybody from a medium to long-term perspective can consider this as a good opportunity. Risk, of course, in such name continues to be regulation around it in terms of data privacy. We all saw how Apple changed its privacy policy last April, and that last April. And as a result, a lot of these businesses found it very difficult to monetize the ad spend. So those kind of further stricter action could be a specific industry specific issue. But we know that consumer behavior on mobile is only going to increase. So that risk can also be mitigated over time. So this is what I would suggest. We are at the end of our thing. In terms of our disclosure, of course, just we mentioned in terms of what kind of disclosure we should have. And we may have our own ratings on these names, which are more directional in perspective. And for those reasons, maybe our comment could be slightly different when we say that. But from an ownership perspective, I don't own any of this name, and happy to take questions if if there are any.
Thanks, Rahul. Yeah, we can stop the slideshow. And to summarize, if I can say that, from the large names that you mentioned, TCS, HCL, and Tata, LTTS, L&T Technology Services would largely fall in that medium risk, medium return bucket. However, the pecking order would be HCL Tech in terms of preference, HCL Tech, followed by TCS, followed by LTTS, followed by Persistent. And Persistent is more like in a bucket of high risk, low return. So that's what I could understood from the larger, to summarize. And the other two names from the non-traditional tech space, some of the names from wherever you have a coverage, the two names that you like is AFL and IRCTC. Is that right?
Yes, perfect.
Sure, great, thanks. So thank you all the 500, almost 550 participants who have joined us today and are still there with us right now. And this session is also happening live on YouTube. So to all people who are asking for recording, in fact, it's going to be available on YouTube. So you can view it on YouTube at leisure later on over the weekend or whenever you feel like, with a stop, start. That's the luxury we get today, even if somebody's missing out. Yeah. So that's there. Let me just now, in the interest of time, we have another 10, max 15 minutes from Rahul. Post that he has to move on for his other institutional meetings. Rahul, some of the questions are around stocks. Actually, there's a question around the tech space, which is a positioning. So the way we have positioned at Research and Ranking is that 14% is the weightage of IT in Nifty. We currently are in an aggressive portfolio. We are having between 10 and 11%, including both the traditional IT as well as the platform companies, right? That's about 11% tops. And for a less aggressive stable portfolios, the positioning would be about 8%, 7 to 8%. So it's about 3 stocks in our aggressive, which is, so in both the cases we are underweight, mildly underweight in aggressive and highly overweight, underweight in less aggressive. So, and that's friends, that's largely the also to a great extent is the position that Rahul is recommending in the session today, which is to remain light on IT sector, technology sector. To what extent you want to be light can depend on individual portfolios, but in no condition should anyone go beyond 14%, because then फिर वो बहुत बड़ा चमत्कार नहीं हो पाएगा आपके portfolio में, right? That's the broader message that we are trying to convey here. After 4 years of big uprun, tech finally had a big meltdown last year. We just saw in the starting slide. For those who missed, you can just refer to the first 1 minute. Last year, Nifty degrew 1%, Nifty IT degrew 21%. And we see no great reason why there could be a major shakeup in the pendulum in the next 1 year. The best case that one can drive here is that it's going to be at par. Let's say Nifty does 14% and IT does 14%. That's the best case as we stand today. And also to conclude, things might change over the next 1 or 2 quarters, but वो 2 quarter के बाद ही हम उस पे बात कर पाएंगे. आज के दिन में ये स्थिति है, right? So that's broadly how I'm trying to summarize, Rahul, your and our put together and overall context. The stock specific, I think the maximum demand is I'll pick up maybe 3 or 4 names, and you can, in case you don't have a firm view or you don't have an official coverage, feel free to say no. So first stock is Infosys. Maybe just a minute on your broader sense on Infosys, and would it between TCS and HCL, or sorry, the other way, HCL and TCS, where would this fall in preference?
Sure. Thanks for that. So if you see Infosys, of course, this result was definitely very nightmarish because after scaling up the guidance in Q1 in January, they have actually seen a very significant impact in this quarter. And this guidance range of 4 to 7% also does not add any confidence to that, because if the company eventually ends up at 4%, it will still be seen as a in line with the guidance, but that 4% is not something which can command the current multiple which it is having. So that way, where is the right price point? Is it 1200 is an attractive zone, or it is a risk zone? Is difficult to gauge at this point. I think their ask rate for their top end of the guidance is upwards of 2.7%, which looks a bit tricky at this point. So I would suggest that we see HCL Tech as a far better choice at this point, and TCS also better than Fee. So in our pecking order, I would say HCL, TCS, and Infosys in that order, if I have to choose in these three names.
Okay, great. That's helpful. The next is Wipro. Yeah, from the large cap. Yeah, and then there are a couple of mid cap names. So yeah, Wipro, a quick sense.
So Wipro, as we saw in the yesterday's earning, they have highlighted negative up to negative 3% of revenue in Q1, which is something very disappointing. And how to recover from that kind of a start of the year to eventually do a decent for the full year is very difficult to understand. I think the only encouraging point out here is the valuation which it is trading at, which is cheap. Then they have also announced a very, very large buyback, which could be slightly accretive. And lastly, they have still a very high bookings, which is up 29%. The only thing they've been highlighting that some of this booking is not translating into revenues because the growth is not, or the deals are not picking up, not ramping up, but they are hopeful that some of this thing will play out in H2. So I think just because they have a very strong booking and the valuations are not very high, I think it still makes sense for somebody who is looking for more than 12 to 18 months to kind of park some money in this name.
Okay. Moving to some mid-cap stroke tier 2 names, if not strictly mid-cap. Tata Elxsi, everyone's favorite till about a year back. It did like some crazy 6-7x from the bottom of COVID. And last 1 year, it's been probably amongst the worst laggards, including from non-IT. What could be a medium-term view and what could be a long-term view, and maybe compared to other similar ER&D names, maybe just a pecking order will help.
So if you look at the business model of Tata Elxsi and try to compare another ER&DS pure play name like LTTS, I don't think they do any significantly different business, or they have some very differentiated capability. I would suggest that business from a capability and opportunity perspective is similar to LTTS. It has changed its business model, and that's why it has seen a massive re-rating in the past. But I think it got a little stretched in that process, and as a result, we have seen a significant correction. But even at the current juncture, I don't think it's the best alternative to play from an ER&DS pure play perspective. At the current point, and if I am looking at this story from a medium to long term perspective, I would see LTTS as a much better alternative, which can deliver similar growth from a 3 to 5 year perspective. And from a valuation perspective, is probably trading at almost 40-45% discount. So that way it make a better choice. I would not suggest anybody to look into Tata Elxsi at this point, given the risk, higher risk on the valuation.
Okay, great. The next name that is in demand is again a laggard. I don't know if you have a coverage, but I'm sure you will still have some view. Birlasoft.
So, our very generalistic view on here, because we don't follow this from a pure coverage perspective, is that when post COVID there was huge demand, IT demand overall, and we saw that there was no people to get onto the job. Companies were paying top dollars to get a less qualified resource just to put somebody on the seat. And what we see that as a result, a lot of very, very small businesses have done extraordinary growth in the last couple of years. Some of the small companies, even including Birlasoft or the likes of Mastec and all. So I'm not saying they're not great businesses, but what I would like to caution is that their growth rate in the last couple of years may not translate on a very consistent basis. If we have to really look at these businesses, we have to see a longer chart of their performance. Of course, Birlasoft was not listed and got merged into part of the KPIT's business. So we don't have a very like-to-like history out there. But as I said, we see risk of slowing growth for the sector would have a bigger impact on smaller businesses, both from what kind of growth they can deliver and what kind of valuation they can deliver. So I don't have a precise view on it, but generally citing this reason, I would not like to venture into this name. And Q3, we saw that they already announced a impact from one of their very large customers. So those kind of event can happen more often in a smaller businesses where the concentration is high, so making it more riskier than what it can do to a larger name.
Sure, thanks. Friend, just to also highlight that, for people who may have missed, the historical premium of a mid-stroke small cap versus large cap, the growth rates would have been in the zone of 3 to 5%. That ballooned to like 9, 10, 12% in the last 2 or 3 years. And as per Rahul's and the consensus, that's again going back to 2 to 3%. Growth rate between a mid cap and large cap. So let's say the large cap names, top 5 are growing at, expected to grow at 10 to 12%. The same here would now be between, let's say, 13 to 15%. So जो growth differential है, उसके सामने जो premium extra market दे रही है, that's kind of unwarranted. Stroke seems to be on a higher side. So some caution is advised. So that's a broader brush one can draw or take, whether it's a KPIT or a Birlasoft or any name in that sense. वो impact आएगा तो सब पे आएगा. तो वो broader message Rahul tried to give in the video.
Yeah, just to add on slightly on a lighter note,
Yeah.
I've been covering this small cap name for more than 12, 13, 14 years. And I imagine, if I recollect my earlier days when I have initiated coverage on names like Persistent, NIT Tech, which is now Coforge, Emphasis, we have all went to investors and said, we want to give a 15p on these companies, and we used to get like ऐसी company को 15p कौन देगा? And now if they are trading at 25 times, we are saying this is a very high P multiple for this business. Now they say you don't have vision. Actually, they can trade at 30, 35 times easily. So that's how it has changed in last 7, 8 years. And as I said, वो recency bias है. 2 साल का नंबर देख के लगता है 20-25% ग्रोथ तो क्या है, आराम से हो जाएगी. The same businesses used to grow 7, 8, 9% in the previous pre-COVID era. And that's what I'm not saying they'll go back to the same number, because a lot of ownership and even management has changed, and they have also gained scale and size. But that is something one should keep in our mind when we try to buy any high P stock.
The next I would say is what's also kind of there in the news. So maybe I don't know if you have a coverage or maybe a quick sense. InfoEdge, and given the way attrition chart that you showed from a big plus to almost negative now. I mean actually negative, no net hiring. What are the kind of implications it has for a company like InfoEdge? Maybe both from a medium term, which is let's say a year, and also maybe from a 2 to 3 year perspective. And the second related is where they have an investment, and is Zomato. So you have a cautionary stroke neutral view. You may be a buyer, but at a lower price. So maybe just these two, and then we can kind of close.
Yeah. So Naukri, as we all know, I mean, there are 2 elements to its valuation. First, of course, is the core business, Naukri.com, which is the only sizable and profitable cash generating business unit in the company. And that we know is function of how the IT hiring kinds of take place. we know we are not in the right cycle on that part, at least for next couple of quarters. We have seen 2 quarters of net decline in terms of the headcount. So I'm sure that business is going to take that hit and is already being talked about from their commentary. So that is on the core business side. Any other business unit which they are supporting have been trying to turn cash flow positive for very, very long. That has not happened, be it on the realty portal or any other segment that they operate into. From their investee portfolio angle, which was another element which was driving the valuation for the business in the last 12 to 18 months. I think Zomato had a spectacular opening, but the mindset of the investors have changed toward this kind of businesses, and they want these businesses to be profitable and cash generating before they want to participate from a valuation angle. I think Zomato has done a hard job of coming to the top 2 and probably top 1 rank in its space, and it's a kind of a duopoly. But consumer behavior would take its own sweet time, in our view, before people start paying for convenience, which can change the trajectory for profitability in that business in a significant way. So that way, Zomato, it's a potential, a large long-term perspective, very large potential opportunity for them, but may not fructify immediately for them. That's my take. But another investee company, which is Policybazaar, I think that business is seeing a natural adoption, because of the insurance penetration and digital consumer behavior. And that part of the thing can possibly add more to the valuation to Info Edge from a near-term perspective. But yes, long-term, Zomato is a very, very big optionality given the kind of positioning it has for Info Edge.
Great. Just before I conclude, so the risk that you mentioned, let's say dollar movement being significantly towards positive, the QT moving to QE, inflation rates, again the IT budgets coming back big time. Assuming some of these play out, what's the best case you think in terms of the timing that could play out before you turn positive? So could it be Q2 of this financial year, or could it be Q3, or you think नहीं यार ये 3 quarter तो अभी रहने ही दो, maybe 4th quarter में ही बात करेंगे of next year? What's that earliest you think on a best case this sector may turn around according to you, and you might want to change your view?
See, generally, unfortunately, businesses where they give guidance, that guidance becomes a key factor. So when we were seeing a lot of negativity around this space in the month of January, February, people were all about like, okay, let's wait for the guidance that will come with Q4, and then we'll take our position. But what we saw is that eventually the stock saw 10-15% correction in the first week of April itself. So now what is the next indicator, really credible, meaningful indicator would be the next Q1, next Q4, right? When they will come out and will give guidance for next year. And of course, during the year, as some of the companies are expecting turnaround to happen in the H2, let's assume some of these companies upgrade their guidance as the year progress. That is what may add to some comfort. And another factor outside of pure guidance could be, what are the regulation changes in the BFSI space? Do we see any other pain in the next couple of months if it's not happening? Or let's say interest rate changes the direction, then we know that the PE can definitely expand and earnings will eventually follow over the next 3 to 4 quarters. So from that perspective, we may change as the year progress. But even in that situation, our preference would be tier 1 names. One can keep adding to their comfort in the next couple of quarters, but would still not suggest anybody to add mid-tier name, at least from a 6 to 9 month perspective.
Great. I think, yeah, there are a flurry of more questions, but given paucity of time, I would like to conclude here. And just on a lighter note, the way people start looking at inflationary stroke, disinflationary stroke, dovish stroke, other recession word in the Fed's commentary, the number of times it gets spoken about. So similarly, the number of times I've used the word technology in the last 24 hours, including with my discussion with Rahul or with clients and internal colleagues, including the way I'm writing, it's like far higher than I've ever done in my life. So that's the impact of technology, and in fact it's whenever we've asked which sector we should be talking about in our next webinar. For some reason, technology has been hovering between 30 to 40%, and BFSI is like a distant second for some strange reason, right? Even though the BFSI is 38% and IT is about 14%. So that's the kind of so-called impact or so-called demand for technology. And I believe a lot of people are now also very closely looking at the FANG and so-called some of the NASDAQ stocks. तो शायद उसका भी impact है इंडिया में कि लोगों को tech में बहुत ज़्यादा रुचि आ गई है. So friends, we've tried to do this in English and a little bit of Hindi, but we can also do something similar after, let's say, a couple of months, maybe a Hindi round. And Rahul's Hindi is as good as anyone else's in the UP stroke MP belt, and he can surprise you with that as well. And also we can get a fresh perspective. And also the idea of today was to get a very independent, informed, neutral view on the sector beyond ours. And it should not be construed that we are trying to get a similar view. In fact, we'll try and get you a view maybe a couple of months later of somebody who is ultra positive. So you can take your own independent view. हमें कोई एक particular direction देने का वो नहीं है interest. We're just trying to give you some of the views, maybe ultra positive, cautionary stroke neutral, which today Rahul is, and somebody who's totally underweight. And then you can take your own informed decisions. And that's largely the message or the approach we have at Research and Ranking. We've taken almost an hour of your time, Rahul. With that, I would like to thank you for spending time with us. And friends, stay with us. We'll have the next half an hour on other sectors, a discussion on other sectors through Q&A, and we'll continue the session. I just want to say thank you to Rahul and let him continue with his other work.
Yeah, so thanks for inviting. Just to conclude on a very small note, when Jasprit was talking about a weightage of BFSI and IT, I think 5, 7, 8 years from now, when we will do this kind of conversation, this weightage thought process would change very differently, because most of the new age businesses, which are essentially, Paytm, which is tech, or which is finance, whether Zomato is tech or food, whether some of the travel companies are travel company, or OTAs are, whether they are tech company, this thing will change, and probably we will see 50-60% of the index will be basically a technology backed business, whether the front face it could be something else, but back end it would be entirely technology. So that's how the landscape may change over time. So that's what just a concluding thought I want to share. Thank you so much for inviting me here, and hope the session was helpful.
Thank you.
Thank you.
Friends, I also have with me my other team members, but let me just hand over to Shyam, who's been waiting patiently to get the mic back, and maybe just take it from here on in terms of what are the other areas on which the audience wants us to capture. Over to you, Shyam.
Thank you so much. Thank you so much, Jasprit ji. So throughout the last 1 hour, I was, as you could see, I was just compiling all the questions that we were getting, right? So I already have 4 pages full of questions, and almost 3 of them are just about questions regarding stocks from the non-IT space, which means from the other space, other areas. So let me begin by what Mr. Ajoy Sinha was asking. He wanted to understand about Pi Industries and Balaji Amin. Pi Industries, PI Industries, and Balaji Amin.
Okay, let me just introduce. So we have our four lead analysts, Parvati, Kimberly, Yash, and Franklin. Let me just call upon Yash to just give a minute each on PI Industries and Balaji. PI Industries, friends, we would have a vested interest because we hold it across multiple portfolios. In fact, they did an acquisition last night, and it's as fresh and as anything in Yash's mind. So maybe he can touch upon that as well. And Balaji, we don't have a specific view, but maybe just a line there on that as well may help. Yash, unmute and over to you.
Sure, thanks. So PI Industries yesterday itself announced 2 acquisitions, and this announcement was waited for a very long time. So in 2020, PI Industries did a QIP of 2,000 crores because they wanted to foray into pharma API space. As we all know, PI is an agrochemical company, and as a natural extension, they also wanted to enter pharma space. So later on, they announced an acquisition of InSwift, but later on, due to lack of approvals, they cancelled the deal, and then the street was waiting for another acquisition within the pharma space. And hopefully after 2 years, they have announced there's 2 acquisitions in the pharma space. And the entire deal value goes up to 900 crores. And this would be funded fully through their QIP proceeds and internal accruals. We feel that this deal is very positive. And even if we look at the valuation, it is almost around 5 times of EV/EBITDA multiple that has been given basis March 22 full year earnings. And we believe that PI will do very well in the API and pharma space, and we believe this deal is very positive. Apart from this, on Balaji Amines, so Balaji Amines is into amines, and we know there is another player that is alkyl amines, and both hold combinedly around 80% of the market share. And we don't have any view on Balaji and this space. We believe there are other players in specialty chemicals which we like, and those can be into fluorination and other spaces. And that's all I think. Yeah.
Thank you so much, Yash. Now I will move on to the next question. This is by Mr. Jugal Kishore, who wanted our inputs on Page Industries.
So Page Industries, I can start with a line saying that it's been a proven compounder historically, but over the last couple of including the COVID period, in the comeback COVID period, but last couple of quarters, that entire space is going through a bit of a struggle, and Page is still trying to make a comeback. Let me just call upon Kimberly to just give a sense why we are more on neutral on that space, the innerwear stroke casual wear space, the level of competition that's increasing, and a quick minute on that will help. We don't have a specific view on Page, by the way, but over to you.
Yeah, so in general, this whole innerwear athleisure space, benefited during COVID because athleisure sales sort of went up. And after that, there's been a sort of slowdown in that segment. And in general, there's been a consumption slowdown for that category. Coupled with that, one of the, cotton prices had increased drastically last year. So that was impacting these players' margins. So even though prices have cooled off, a lot of these players are sitting on like higher cost inventory, which is why their margins are still not recovered to their previous highs. And also the most of these players deal through distribution network. So this sort of like inventory sitting at the distribution level. So even if there is secondary demand, because the distributors and retailers are sitting on some level of inventory, your primary sales are picking up a little slower, even though there might be secondary demand may pick up faster. So that sort of slowdown has played out in the last couple of quarters, and maybe a couple of quarters of more pain in that sector, because of the slowdown in consumption and high inventory sitting in the channel.
Friends, just to add, last evening, acquisition of the Raymond's consumer business. In fact, it didn't include their innerwear stroke casual wear. So that they've only sold off their consumer business, which is which is around deodorants, perfumes, the KS brand, and the shampoos and around that too. So that also shows that space they want to maybe related to apparel, and also in a way still a very, very fast growing space, and maybe Raymond wants to continue to have some bit of share there. Just to add to that. Yeah. Over to you, Shal.
Yeah, thank you so much. So then we move on to the next question asked by Mr. Sunil Babbar. So he wanted to understand about IRCTC and Naukri. Now, from what I observed, Mr. Rahul already spoke about IRCTC. If you may want to add something to it, then good. And the other stock is Naukri.
Let me just ask Kimberly to just come back and just maybe talk a minute each why we still continue to remain. So friends, these stocks are there in most of our older portfolios. We've not kind of added anything in the last year and a half. Why we've still held on, we remain hopeful that they should make a comeback. It's a matter of time. They are not down and out stories. मतलब इतना खराब भी नहीं है कि उनको मतलब हमें loss पे बेचना पड़ जाए. So we remain hopeful, but we hold it in very, very limited portfolios. In some cases we have actually rebalanced it, but in some portfolios we continue to hold. So maybe a minute each on these two, Kimberly, please.
In IRCTC, like Rahul had mentioned earlier, that obviously the potential is there because of all the additional revenue streams that they could get. But the only issue remains is that, they are susceptible to policy changes by the government. And, in the past there have been the revenue share agreement, the revenue share sort of arrangement has been negotiated, which has impacted the stock price. So as Rahul mentioned also, that there were no near-term triggers as such. And, the potential remains, but currently maybe the risk reward potential maybe not as favorable. And with respect to Naukri or InfoEdge, so again, the investee companies correction and the valuation correction that the tech space has seen is one of the factors that has impacted InfoEdge. And, they benefited a lot during COVID from the attrition rates. And because of that, their, billings growth was very strong in high double digits. So obviously IT trends slowing down has, led to some impact. But that being said, your other sectors continue to see strong demand in hiring, whether it's travel, hospitality, BFSI. And, it remains a strong cash generating company and profitable. So again, a lot of potential in the long term.
Thank you so much. Thank you so much, Kimberly. There is another question in the consumer staple space. So there are questions asked by Mr. Vikram Sahu and Mr. Venkat, who are keen to know about Tata Consumer, Godrej Consumer, HUL. So these are a few more names on which you could share some insights.
Yeah, so just like a broader insight is that obviously in FMCG, most of the companies have seen a reversal of your material prices and they have been cooling off. So that is positive for their margins going forward because now they can spend more on advertising and sort of bring back that demand. More specific to HUL recently declared its result. So volume growth was a slight miss, which shows that, there is still some stress in the rural demand and that will take some time to come back. But that being said, HUL is present in more well-known categories that are already well penetrated in the country and they're already leaders in those categories. But if we look at a Tata Consumer or Godrej, they are present in, categories that are very under-penetrated. Like, for example, Godrej Consumer in air fresheners and household insecticides, while Tata Consumer is getting into, spices and staples. So there's a lot of work involved in these categories for these companies. So that's why they have a longer runway for growth because they have to also invest in growing the category in the country. And then, that's how they will get their growth. So, the whole FMCG space obviously looks interesting from different angles. But yeah, margins wise, there is like some upside in the near term.
Thanks, Kimberly. Now, there are questions around the banking space as well. So, Mr. Amit Day, he wanted to know about HDFC Bank, ICICI Bank, IDFC Bank. So if light can be thrown on the banking sector as well, especially these three names.
So, HDFC, ICICI and?
IDFC.
IDFC, yeah. So all three are held by us. So again, just a disclaimer: we hold these either two of these three in most of our portfolios. So we'll obviously have a vested interest. And over to you, Franklin, if you can unmute, and just a minute each on these three, and why you believe that there is still reasonable upside to be made, and they are probably the better ones amongst all others in the current environment.
Yeah, thanks a lot. Starting with HDFC Bank, HDFC Bank, over the last many years has displayed, very consistent performance. And even if you see the latest quarter also, they have displayed very resilient performance, growing their book, by 17%, the advances book. And the deposits was one of the highest at, so far at 20% YOY. They've been investing very well in branches, and their employees, the distribution. The last 2 years itself, their branch network has, increased the branch network by 40%. So that is how they are positioning themselves, to take advantage of the next leg of growth. And in this environment, credit cost has been very low, and they are taking advantage by investing that into their business for future growth. So that is how HDFC Bank is. They think ahead of the curve and try to prepare for the future as well. So that has been the strategy. By the bank for a long period of time, and that is well in place. So we're very positive on the bank, and we feel that the growth that they have displayed in the past many years, that kind of growth is likely to continue. Also, with the merger process is in place. Most likely, it is expected to be completed by the month of July. And they have received all the major approvals, whichever they required. So there is nothing which is stopping them now, and the merged entity is likely to be much bigger, much stronger, because home loan in the retail space, home loan is one piece which is a very significant piece of any retail book. But that was something which was not present for HDFC Bank. But now with the merger, the home loan piece will also get added to its product portfolio. And there is a lot of cross-selling capabilities which are present in the merged entity, because there is only a 30% overlap between the customers of HDFC Limited and HDFC Bank. So that will help them to increase the product portfolio and grow the bank in a much stronger manner. They're already at 16 lakh crore of loan book, just HDFC Bank, and HDFC Limited is another 5 to 6 lakh crores. So the combined entity will be a very strong force. Coming to ICICI Bank, ICICI Bank has also displayed a very strong performance, specifically in the last 4 years, because they had been impacted because of the corporate issues. Their book was impacted in FY16, FY17. But coming from there, they have kind of picked up their business quite well, and they are almost on par with the likes of with HDFC Bank. So they've been able to grow their margins as well in the last 3-4 quarters. This margins currently standing at 4.9%. Which used to be just 3.3, 3.4% about 3 years back. So you can see the kind of improvement that they have displayed in their margin. And last 8 quarters, they have been consistently growing their advances book at 15% YOY. So even in this quarter, they grew at 19%. So that has been the kind of consistency with which ICICI Bank has gone about their performance. And they are also slowly expanding their branch network, as they believe that they will need to invest for future growth prospects. So we continue to remain very bullish on ICICI Bank as well. Coming to IDFC Bank, IDFC Bank has had its challenges because of their corporate book. If you see the last 4-5 years history, they recently became a bank just in 2016. So from that period onwards, they had a branch network of they had just 3 branches. So they had to invest a lot in their branch network. But today they stand at about 700 branches. So the cost to income ratio presently is a little bit on the higher side. at around 74-75%, but that's because they had to invest a lot in their branch network. So as we move forward, the cost to income ratio is likely to improve for IDFC Bank. It has already started showing improvement from that 77-78%, which it was a year and a half back. And it is likely to come down to 60% in the next 4 to 6 quarters. So that will give a strong growth lever. And credit costs are also coming down. The bank is also showing a strong improvement in performance. The corporate pain, which was there for the bank, is now behind us. Benign credit costs coupled with improvement in cost to income ratio is likely to improve the ROEs for the bank. And currently their exit ROE was 10%, and they are likely to scale 15% at least in the next 5 to 6 quarters and go beyond that. And on a sustainable basis, they are definitely likely to do 17-18% ROEs, maybe from a 3 to 5 year perspective. So structurally, the bank is doing well. Even on the growth front, they have been able to clock 20% plus growth for the last 3 quarters now. So there is some consistency which is coming in, and the performance is likely to continue going forward.
Thanks, Franklin. Friends, before I move, I just want to read out the disclaimer once again that the stocks that we are discussing today should not be considered as a buy, sell, or a hold recommendations by Research and Ranking. Please use it largely only for education and illustration purpose. Do consult your investment advisor. Whether it is Research and Ranking or anyone else, today's forum is a mix of both our current clients as well as people who are in discussion with us in terms of seeking our services. So that's a standard disclaimer. Whatever portfolio, whatever stocks that you've been allocated, please go through that. That has been done with the best interest and keeping your risk profile. And lastly, acquaintances or group companies, their directors, employees, affiliates, relatives, or me, we may have a financial stroke vested interest in the stocks getting discussed during the webinar. With that, and there's a lot of people who are genuinely, sending a flurry of stocks on which they want an opinion. So it might be difficult to share a view on all the stocks of all the individuals. So wherever we may not be able to revert, we'll try and catch it up, cover it up in the next webinar. Alternatively, if you are our customer and do write to us in case we are able to send you back or revert back to you over the email through the ops email ID. We would try and do so. So there's no promise. We will definitely try and do so, especially for our Dhanwan or premium members. Over to you, Shah.
Thank you so much, Jaspreet, and thank you, Franklin, for that in-depth analysis on those 3 banks. Now we can move on to the specialty chemical space, because I could see there were quite a few questions from that space as well. So Mr. Dinesh wanted our views on Indoco, Sumichem, Tatwa, and Mr. Raghu wanted to know about Deepak Nitrite.
So if I can repeat the name, Deepak Nitrite,
Indoco, Sumichem, and Tatwa.
Okay, so we only have a view stroke, some sense on 2 of these, which is Sumi and the first name that you said, sorry, Deepak, right?
Yes.
Deepak, yeah.
Yes.
So Yash, just a quick minute on each of these, Deepak and Sumi.
Right. So Deepak Nitrite, as we all know, it has 2 divisions. One is your advanced markets and second is the phenolics division. Now the pressure or the pain is more on the phenolic side, and that is why we are seeing that the margins are under pressure, the operating margins. This is mainly because as we look in the COVID era, what happened is that there was a huge demand for phenol, and that's why globally the phenol prices were at high and there were good spreads between phenol and acetone. And Deepak Nitrite used to enjoy good margins or better margins. And later on, as the demand has waved off, we have seen a steep correction in phenol prices, and that is why there is some pressure on margins. But the good part over here is that now what they have started is that they have done more R&D and they are entering into the derivative products of phenol, such as MIBC and MIBK. And we expect that this derivative products will have a better margin, and the overall margin of the company should improve in the coming years, and we remain positive on Deepak. The second stock is that Sumitomo Chemical. So Sumitomo Chemical is an agrochemical company. Of course, it is doing very well. But if you whether well, so last I think 6 months back, a government issued a notification that the use of glyphosate is banned, but it can be only used through an approved PCO, that is a pest control operator. So there is no impact on the direct sales for a company. Only the spraying on the crop should be through an approved PCO. So there would be some demand softness, and we can expect that volume of tech would be slightly impacted due to this. But the company has given a statement that they are going to conduct trainings for their employees, and this trainings could be done within a time 3 to 6 months. And of course, then the employees would be able to spray and help farmers. And of course, there cannot be a direct ban on the usage of glyphosate, as it is a very important chemical for farmers as well as for the Indian agrochemical industry. So of course, near term there are some headwinds, but we believe given the legacy of Sumitomo, of course the company will come out of this headwind soon.
Thanks, Yash. Yeah, Mr. Somnath is having a question around Mastic. We've done a lot of discussion around IT in the first 1 hour, so we were and they were limited questions. So, but we'll still take up your questions since you're a premium member. And thanks all of you for all others for understanding that we may not be able to cover each and every request for each and every stock. So as I said, do feel free to write to us on the operations email ID, ops email ID, customer service email ID, and we'll try and best to revert on it in a couple of days. That's again not a promise, but on a best effort basis, we'll try and do that. And thanks to all others who are appreciating the webinar today. Over to you, Parvati, for a quick minute on Mastic. Maybe what are the challenges and why we think, and we have it, just a disclaimer, we have it in very, very selected portfolios in some of our pool, and why we think there could be a better price before we take a call in terms of exit, if not the current price.
Yeah. On Mastic, we need to understand that this company is slightly different from the other IT companies in the form that they have more exposure, one, towards Europe, and from a business vertical perspective, they have government contracts at around 60% of their revenue, and another 20, 25, 35%, 20% odd with respect to healthcare. So when we talk of healthcare, within that also it is primarily NHS contracts that they work with. And one of this has been a pain point with the company for last few quarters, given that there has been a merger between NHS UK and NHS Europe overall, where the decision making has slowed down. And that's where they have also deferred some bit of revenue, which was announced last quarter. So this continues to be a drag. I mean, apart from NHS, the healthcare segment is picking up, but not as much because the company is trying to refocus their interest into other verticals as well. From a government perspective, the deals that they work is more with here the decision making also has gone slow given the macroeconomic slowdown and has impacted the stock. What they're trying to do is they're trying to move more on the private sectors and the other verticals. So recently when they made an acquisition in the US, which was MST, while it does have a small percentage from government works, it is more on the private side. So yeah, the company is putting all the right efforts to kind of expand their vertical presence as well as the regional exposure, although it will take some time to materialize. So in the near term, some stress could still continue within the company's performance. Over to you, Shyam.
Thanks, Parvati, for that. I will just request Naveen to just drop in. We're just having, friends, 2 poll questions just to understand what is the current portfolio value, and this is all on a no-name basis. So we're not getting any names, but general an idea about what's the current portfolio value and how much more you can deploy over the next 1 year. So the first question is around the current portfolio value. So what is your current portfolio value? Again, just broader brackets, if you can share, it'll be very helpful. This helps in our overall strategy. Whether we can give a stock which is in 4 digits, 5 digits, has a low liquidity, high liquidity, high risk, low risk. So उन सब में बहुत help करता है ये हमें decide करने के लिए. So just 2 questions and it'll be helpful. So another 10 seconds and we can move to the next question. And this is the current market value, not how much you had put in. If you had put in 10 lakhs 3 years back, today it's 20 lakhs. So just select accordingly. And if you had put, let's say, 20 lakhs a month back, and today it's about 18 lakhs. So you can select accordingly. Current market value. Yeah, thank you so much. We can move to the next question, which is the how much money you would like to and definitely have the capacity to invest over the next 1 year, over and above your current portfolio value. तो आज अगर मेरे पास 20 लाख का portfolio में 10 लाख और डाल सकता हूँ, तो maybe you can select accordingly. Over the next 1 year, this is over the next 1 year. How much more? If it's zilch, if it's zero, you can select maybe less than 5 lakhs. Yeah. The last question, and then I'll hand it over back to Shyam, and we'll try and wrap it up with the next 5 minutes as well. Thank you so much. Over to you, Shyam.
Thank you so much, Jaspreet ji. Thank you so much, friends, for participating in the poll. As Jaspreet ji mentioned, we have another 5 minutes, so maybe a couple of questions. Now that we are in the middle of a very hot and sweltering Indian summer, I could see there were some questions about Voltas and V-Guard. So if we could pick up or if we could share our thoughts on these companies.
Yeah, Yash. So V-Guard, we don't have a view. But Voltas, definitely they had a result recently and it was not great, but maybe whatever sense you have. We don't have a view on any of these, but whatever sense you can give on both these names, Yash.
Right. So Voltas is facing a lot of pressures in terms of margin, because what has happened is that if we look at the Indian domestic market, and Voltas was a market leader and still continues to be a market leader, but 2 years back Voltas used to enjoy a market share of more than 25%, and as on yesterday what the company has reported, the market share as on FY23 is somewhat at 22%. This has been for last 2 years. Voltas is losing its market share in India, and due to this loss in share of market, what is happening is Voltas is not able to pass on the full costs, the cost inflation to the customers, because they want to be competitive also, and whereas the other players such as Lloyd and Blue Star are gaining market share. And apart from this, they are offering higher discounts as well as higher incentives to the dealers. So this is helping them to push their volumes, and Voltas in a way is not able to sell competitively. Apart from this, if you are aware, so Croma, one of the largest retail chain in India, itself is cannibalizing the products of Voltas. So if you walk down to a Croma store itself, the Croma executives will tell you that why to go for Voltas, buy an Croma product itself. So it is a same group company competing internally itself is also impacting the market share of Voltas, and that is why Voltas is struggling, and there is some pressure on margins since they are not able to pass on the full cost, the full inflation cost to the customers.
Thank you so much, Yash. I'll move on to, I believe we have time for maybe a couple of questions. So the first question would be on Jubilant Foodworks and Somani Ceramics.
Let me take up Somani. So Somani has been trying to make a comeback, and we have it only in very selected pool, largely in MPO. And we are hopeful that this space, this industry, which is the organized tile industry, because of increasing exports, therefore more bees increasing, जो भी उनका threat था domestic की तरफ, वो divert हो जाएगा US, Europe and other exports, तो उतना उनका supply domestic में कम रहेगा. So that's positive for the large organized players, the top 5 especially, जहाँ पे Somani एक आता है. And also the cash prices are on the downward trend, so that will also help. And Somani is obviously trying to make a comeback through increased advertisements, high growth, etc. So we remain reasonably optimistic on this name, but only from a short-term perspective. That's why we hold in very selected portfolios only in MPO. So I'll just want to get back. Kimberly, to just maybe spend a minute each on both Jubilant and Zomato, because there were questions around both of these names. Kimberly, if you can just talk about both Jubilant and Zomato, and that would be the last order of the day for, or last stock request to you. Yeah.
Yeah. So on Jubilant, as we know, they've been one of the pioneers in India in QSR, in the QSR segment. They've also pioneered the whole home delivery space long before Zomato and Swiggy came in. So they do have their strengths. They are a 20-25% ROE, ROC business, one of the largest footprint in India with over 1,300 stores, and they are opening 250 stores every year. But that being said, they have seen a few, headwinds in the last couple of years. So one is, of course, the competition increasing in the pizza space. So they were a leader in that space, and now you have so many homegrown brands, cloud kitchens, and other listed players getting aggressive now. Also with, post-COVID, with, everything opening up, people, the delivery momentum slowed down for them, and they're not a well-known dine-in player. So they didn't benefit from, reopening of the economy. And the most importantly, inflation-wise, cheese prices are at a decadal high, and they continue to remain elevated. So, versus any other QSR player, Domino's has majority of its RM as cheese, almost 40% of its raw material is cheese. So they can't really compromise on that, and that's where they've taken a hit on margins as well. So that's been one of the concerns with Jubilant over the past year. But obviously there is an upside as well. They have another franchise that they are expanding, which is the Popeyes fried chicken franchise. So it'll be interesting to see how that plays out for them. If there's any further upside they can see from another franchise expansion. Zomato, obviously, as we all know, they are duopoly in this market of food tech delivery, and the market is already very underpenetrated in India. So, there's barely like 5 or 6 crore people in a population of 140 crore people who order food online, and that too the frequency will be, very minimal compared to global countries. So it's all a game of increasing your frequency and number of users over the next few years, which is how they'll benefit. And they're already a leader in this space, right? So there's very less disruption that can happen with new players right now. And secondly, they've already broken even in the food delivery space. So they're not burning cash in food delivery anymore. It's only because they acquired Blinkit, which is why, they're reporting losses still. But at a cash break-even level, they've already broken even in the food business, which has taken time for the market to build, but they've sort of achieved that last quarter. And, so I think that will be a positive stance to see how they maintain their profitability going ahead. And obviously, one of the key risks involved in this business is the whole gig worker space. As we know, recently there was some news around Blinkit. So, those are news sort of things that keep coming up that, weigh on the stock. But if you look at the long-term picture, there is a runway for growth. There is under-penetration. They are a leader. And plus, they've, hit profitability at cash level. So it'll be something to watch out for in the near term.
Thanks. Thank you, Kimberly, for that. Friends, the request for presentation. So we won't be able to share presentations. Wherever there is a request, do please send us an email, and we'll be able to happily share a recording of the session. That's one. And let me just try, in the interest of time, we only have 2 minutes left. So maybe I request Shyam to, we can try and do a rapid fire in which we can just, Shyam will give out names, and I'll just say view or no view or whatever on a best effort basis, so that we're able to accommodate a maximum in the last 2 minutes. Yeah, over to you, Shyam.
Sure, thank you so much. So I could see there are some names like Polyplex, Prince Pipes, Rosary, Sona Comstar, and Uno-Minda. So any views or any thoughts on these?
So between Uno-Minda and Sona Comstar, we both we like both the names, but both are more like a comeback stories. One should only choose one. These are the current our top 2 picks in the auto ang space, but we would high risk investor. Sona may be better for a medium risk. High risk Sona Comstar, and for a medium risk Uno-Minda. And that's that, but only one between the two, and that too the allocations no more than 3 to 3.5%. Again, please do your own research, and only then take a call. And if it's whatever's been there in your portfolio, do it's with a purpose, so limit to that as well. Polyplex, sorry, we don't have a view. Yeah, which were the other 2 names, Shyam?
Rosary.
Rosary, we don't have a view.
and Rajratan Global Wire.
Rajratan Global Wire is a great name, but I would say probably the best is behind in terms of the way it moved up in the last like 3x, 4x in the last 3 to 4 years. They've done a brilliant job in terms of their market share, the way they've grown in India and outside Thailand and other Southeast Asia. And obviously the tire industry, उनके जो wires हैं वो tire industry में जाते हैं, but they've gained market share. So probably if somebody's not bought earlier, this may not be the right time. Their quarterly profit went up from like 20 crores to as high as, I think, if I'm not wrong, 120 crores, maybe 130, I don't remember, in the peak, and now it's back to 80 crores. I'm talking about the quarterly run rate profit. So maybe I would say watch out for the next quarter, and then take a call. That may be a better way. And again, but take a call with a longer term view, because it's not a quick fire thing where it can give you a quick results.
Jaspreet, then there were questions related to companies from the financial services space, which are not banks. So, for example, there is HDFC Life, there is UTI, AMC, Bajaj Finance, and M&M Finance.
Bajaj Finance are there in most of our portfolios, but from a SG structural growth long-term perspective, 4 to 5 years, 3 to 5 years view, obviously there are near-term headwinds, more specifically in terms of valuation. But we believe the allocations can be reduced. Instead of a 6-7%, one can look more like a 4%, 4.5%. But you need to have solid names like BAF in one's portfolio. So that's one. Again, depending on risk profile to each, that's there. M&M Finance at current juncture, we don't have a view. We are more like neutral to stroke no view. The other name, sorry, you said is?
So there is HDFC Life and
AMC. So yeah, these two spaces, we are not very positive, both life insurance and AMC business. Barring maybe one odd name, maybe on the unlisted space in case it comes up. But overall, these two spaces seems to be, especially in the recent budget, after which the earlier LIC got listed, and now there is some bit of because of competitive incentive, even LIC is becoming aggressive, and the recent changes in the budget around insurance space, that makes it not so lucrative as it was earlier. So we play through the proxy, and one of the digital companies, leading platform digital companies, we have it in very selected portfolios. That's how we would like to play it. And AMC again, again, not very positive, as I said, barring maybe one odd name from the unlisted space.
Then I could see there were questions related to Tanla platform, Tips Industries, and LIC as well.
No, we won't have view on Tanla, Tips. LIC obviously would be more like a struggle in terms of trying to make a comeback. The issue price is the current price is far below the issue price, and one is obviously the insurance industry which is in a slight downtrend, especially as I said in the last budget after that announcements. Two, overall markets are in that neutral stock, especially the heavyweights, and so that is also playing a role on LIC's NAV. And third, the competitive intensity itni मारधाड़ है, सब लोग they're trying to get market share, and market share लेंगे किससे? सब LIC से लेते हैं, and LIC is also now trying to ensure कि उनका और market share loss ना हो. So it's a very tough space to be in, especially for a product which was earlier getting sold to a great extent through the tax incentives under that break in the IT, this thing, which is now obviously a large part of that is now taken off. So उसका थोड़ा सा अपने प्योर मेरिट पे आगे जाके उतना बेचना, उतनी ग्रोथ आना शायद मुश्किल हो जाएगा. So therefore we not very positive on that team. So maybe the last request, and then we can conclude. Yeah.
Yes. So the last question for the day, Samvardhan Motherson, NMDC, Laurus Labs, and Lupin.
Maybe I'll request. So Samadhan, we don't have a view. NMDC we have in very selected portfolios, but we were largely playing the demerger story. which is now over, and now it's trying to the steel business. And once it gets listed, once it gets commissioned, the new plant, I think June, I don't remember, June or July they're talking about to get it commissioned. फिर उसमें से output निकलेगा, and maybe after that, once it gets sold off, तो वो complete value discovery होगा. But not at current prices, yeah, unless you had bought earlier, not at current price. So the last two names, may I just request Parvati to just give a very, very quick sense on Lupin and Laurus, especially because Laurus had a call last evening, and there's something fresh that you want to share. Yeah. So last two names, Laurus and Lupin.
Okay, so on Laurus, the results were out yesterday. The numbers look weak primarily on prima facie because of their CDMO business, which was doing well in the past few quarters. Essentially, there was a big order which they had in the early part of the year, and the contract got over, wherein in Q4 there was absolutely no revenue from this large order book, which they had already completed in the Q3. And the average run rate now stands for the CDMO business quarterly at around 250 quarters. And that's so while no guidance has been given either on the CDMO business from a futuristic perspective or on such deals, the company also refrained from giving any guidance given the uncertainty with respect to the pricing environment. So even in their generics business, both formulations and APIs, no outlook was given, and they said that it will be given in the next couple of quarters. Apart from that, the company is now also trying to kind of move out from antiretrovirals, especially, and on the formulations and generic side both, and focus on the other kinds of APIs, more so on oncos and other bits. Similarly, on the CDMO business, they are looking to take up the exposure as a part of revenue from 36% or to 50% by FY25. So all this looks more to kind of diversify their product portfolio and have a better mix so that they're not more concentrated and the revenues and margins not as hit as was seen in the last 1 year. Similarly, for Lupin also, the company continues to remain weak from a performance perspective, and we'll wait for the results for now.
Thanks, Parvati. Before I hand over to Shyam, a quick thank you to all the team members who are not there facing the camera today, like Amey, like Tanshi, like Mosmi from the research team, and so many others from the operations and digital team, Chandramani and his team, Naveen, Rahi, Vinay, Archana, so many other people who work tirelessly on the back end but don't get to share the limelight as such. A big thank you to all of them for allowing us to execute this today very, very smoothly. Over to you, Shyam.
Thank you so much, Jaspreet ji and Arena team. Friends, we got a great response today, almost close to 2,000 registrations, and I could see that more than 500 people have attended this session. And on behalf of the Arena team, we hope that you found this session valuable, especially because maybe Jaspreet ji can correct me if I'm wrong, but for the first time we had an external person also as a guest speaker or a guest panelist in our discussion. So on those lines, friends, thank you so much for being so participative. We would also like to highlight that we have got so many questions, but we could pick only a fraction of those in the interest of time. But we promise you that we will keep having these sessions in the future where we will be answering more and more questions. On that note, we wish you all a long weekend, a happy weekend, and thank you so much once again.